Welcome back, everyone. Today on The Joseph Carlson Show, Adam Aron, the meme CEO of a chain of theaters, is buying a large stake in a gold mining company to diversify his business. Howard Schultz is returning to Starbucks for a third time, and he's going to try to deal with a lot of the mess that Starbucks is in with the unionization effort and the problems with their growth in China. And as you may have heard, the Fed just increased interest rates by 0.25%. That took effect today, and mortgage rates are already topping 4%, which is the highest since 2019. So we'll be discussing all of those things, plus I'll be giving a portfolio update on my passive income account. So let's go ahead and jump right in. This, of course, is my passive income portfolio. For those of you new, this is a portfolio that is real. It's real money, it's my money, and I track it every single week publicly with complete transparency, which simply means that you see the results every single week without any gimmicks. You can just see what happens. Every single company that I invest in, you can see the results of them, whether they turn out good or whether they turn out bad. For example, I recently purchased into some core positions in ETFs. I purchased SCHG, which is a large cap growth ETF, at the exact wrong time. I bought it right at the high, and it's down 15%, which is $5,700. I also purchased BST, which is a covered call ETF, where they sell specific covered calls on software companies. And I also purchased this one at the exact wrong time, right when software companies were getting their multiples contracted. And it's down $1,600. So these are two positions and two ETFs that are detracting from my performance. The biggest contributors to my performance are these two companies in tech and cloud computing, Apple and Microsoft, but mostly Apple. I'm up $18,100 on Apple and $3,000 on Microsoft. So with Apple, I'm heavily in the green on this company, and I still think it's an attractively valued company when I weigh the upside and downside. And even though I'm more neutral on Microsoft, only $3,000 in the green, I've contributed more money to this company because I see over the next decade a lot of compounding ahead of it. My consumer picks also follow one company making the majority of the gains. That company is Costco. It makes up $9,400 of the gains. Disney so far is in the red. This one has been somewhat of a flop so far, but I remain very bullish on its future. Home Depot is one that's doing okay right now. It gave up a lot of its gains with this sell-off. Nike is basically flat. This is one that I'm just kicking myself for not taking some gains when it seemed to be overpriced. I should have locked in some gains around 6 months ago on that company. And Target's one that I've over doubled my money in. If we go to real estate, I've minimized my amount of holdings here. In real estate, I basically hold one company, which is Vici. I have some holding in MGP, which is MGM Growth Properties, but Vici is buying MGP. So this is actually going to be converted to Vici shares later on this year. Vici's still in the red. I've basically never been in the green on this company, but it's only traded down a couple thousand and it's stayed there for the past 6 months. So it really hasn't sold off quite as much as the rest of the market. And this is one that I remain long-term bullish on, but I realize it's going to be a slow-moving company. It is, after all, a real estate company. In the restaurant category, we have some other newer holdings. Starbucks is one that I've been recently buying into. Very bullish on this company, but we're going to be talking later in this episode about some of the challenges they're facing. And Texas Roadhouse is one of the casual dining restaurants that I think will have a lot of opportunity the rest of this year to increase their operating income and their fundamentals, which I think will drive up the stock price. And then the last category in my portfolio is the banking sector. We have JPMorgan Chase, which I recently purchased more of, as I think financials will do pretty well over the next 5 years. Unless we go into a 2008-like recession, financial companies actually make more money when interest rates go up. They actually have a better spread between what they can charge consumers and the interest that they make, and that makes them more profitable. So that's a basic summary of the portfolio. But overall, I look for a collection of solid companies with strong fundamentals that have good growth prospects, but also do aggressive buybacks and aggressive dividend raises. So right now, there's a lot of YouTubers, a lot of people making content of doom and gloom and the upcoming recession, everything that can go bad. But realize that if you're in your 20s or 30s, or even 40s, you have a long investment horizon ahead of you. And one recession is to be expected during your lifetime. That's not really a significant problem. If you keep investing and dollar cost averaging into good companies, you're likely to do just fine. Now that's my portfolio. If you want to see every single holding, there's a link in the description that shows all of them. Let's go ahead and move on to some news. There's some news that you have to take a double take. You look at it once and then you look back again and you go, was that real? Did I really just read something there that was real? We have Adam Aron, who is the renowned leader of the apes. He is the meme leader of AMC. And he tweeted out, that he is playing on the offense again with a bold diversification move. We just purchased 22% of Highcraft Mining of Northern Nevada. It has 15 million ounces of gold resources and 600 million ounces of silver resources. Our expertise, again, he is the ape leader of the meme movement of AMC, a chain of movie theaters. He says that his expertise is going to help them bolster their liquidity. So we can just let that soak in a little bit. We have the AMC leader of a chain of movie theaters buying a stake in a gold mining company. Now I know what all of you are going to do. You're going to scoff and you're going to criticize and you're going to say, how does this make sense for a movie theater to be buying a gold mining company? Well, that's where you may be wrong. So before you jump in with your criticisms, let's go ahead and see how this may actually be a genius move. Matt Levine, a contributor at Bloomberg, writes how this could be one of the best strategic moves that AMC could make. Let me go ahead and just highlight some of the key arguments here. First of all, AMC stock is in some sense an ownership share in a chain of movie theaters. That's what you think on the surface, that when you're buying AMC stock, you're buying a chain of movie theaters. Well, that's where you would be wrong. You see, if we jot an AMC to Qualtrim, which again, this is available to all patron members, you can see that the price to sales is above a 3. Which makes AMC have a market cap of $7.82 billion. Well, most of the time, in most cases, movie theaters, which is a industry that's in secular decline, would not be trading at a price to sales of 3. That's pretty close to the price to sales that Amazon trades at. We can see that Cinemark trades at a more reasonable price to sales of 1.3, less than half the valuation of AMC. And Cinemark has arguably a better balance sheet. They have more attractive buildings. They're actually in better shape overall. But despite that, AMC trades at a premium. And the reason why is because AMC differs from Cinemark in that Cinemark is just a movie theater chain, while AMC is much more. In another sense, it is a financial instrument that reflects Adam Aron. Adam Aron is the reason that AMC can demand double the valuation of other industry competitors. His ability to do funny things that attract attention and delight people online. That's his specialty. The stock goes up because people online get excited, not because AMC sells more movie tickets. That's another important distinction. And so it makes sense for AMC to expand into new and unrelated ways of doing funny stuff online. This is their master plan. So buying a stake of a gold mine company gives AMC some meme diversification. For one thing, this purchase is itself a funny thing that attracts attention and delights people online. AMC stock was up about 2.5% after this announcement, but also, gold has been a meme for millennia. Owning a gold mine just gives you more opportunity to say stuff that attracts attention. Quote, the Fed has printed too much money and hyperinflation is around the corner. Buy more movie tickets. That sounds weird, right? But saying buy gold totally works. It's just a huge expansion of overall meme arsenal. So Matt argues here that the biggest value proposition that this gold mine has to AMC is a diversification of meme potential. And I think that's important to factor in. And if you look deeper at the strategy, this actually makes more sense. In a way, Adam Aron is just like Warren Buffett. He has diversified his business into seemingly unrelated assets, and he's doing this at seemingly attractive valuations, building up the overall diversification, the earnings of his company. This is him as an executive of a movie theater chain, making unique and specific investments into unrelated businesses. With the power that Adam Aron has, with his meme power, he actually can make it so that companies can get high valuations right as they're doing at the money market offerings, meaning they issue and dilute a bunch of shares, offloading those to investors right as their stock price goes up. That is a very incredible power that makes a lot of executives very, very rich. Matt says that if he ran a microcap company today and he was looking to raise money, here is what he would do. Get everything ready to file a large at-the-market offering. Ask Adam Aron what I should do to attract attention to my stock. Do whatever he tells me, because he is very good at attracting attention and using the attention to do at-the-money offerings into the rising markets. Immediately file the at-the-money offering and bank out all of the stock to retail investors who are pushing up the stock price because they are thrilled by whatever Adam Aron suggested. This is a formula that Adam Aron is incredibly good at. He is selling his stock two unknowing investors that are gladly paying an extra premium because he's good at attracting attention. And in a way, Adam Aron may actually become the new Warren Buffett. And I know that's a little bit blasphemous to even suggest, but go ahead and hear him out on this. One way to interpret this is that Adam Aron is sort of the Warren Buffett of meme stocks. Yes, sure, in a sense, he is now apparently building a diversified conglomerate of unrelated businesses. But also, this is the basic way that Warren Buffett works. When he announces an investment in a stock, that stock price goes up. He knows that, and companies know that as well. And he charges those companies for that. For example, if you are Goldman Sachs Group and there's a financial crisis, you might go to Warren Buffett for money. If he invests $5 billion, that will validate their business and reassure other investors. This will cause your stock to go up and make it easier for you to raise lots of more money at better prices. So it is fine for you to raise the $5 billion from Buffett at a horrible price. Give him a sweet deal. Who cares? It will make everything else better for you. That is very accurate. There's a lot of companies that will give Warren Buffett and Berkshire an attractive valuation, one that doesn't even make sense because they know if they get Buffett on board, there's a horde of other investors that will pile in after him. So it's okay to give Buffett the discount in those situations. Similarly, if you are a micro-cap gold company and you need money to mine gold, you might go to AMC for money. If AMC invests $28 million, that will make your stock a meme and attract retail investors. This will cause your stock price to go up and make it easier for you to raise a lot of money at better prices. So it's fine for you to raise the $28 million from AMC at a horrible price. Give it a sweet deal. Who cares? It will make everything else better for you. So you may have mocked Adam Aron. You may have scoffed at this news when you first heard it. What can Adam Aron, the person running a string of movie theaters, what does he know about gold mining? What can he possibly do to help this company? But that's not really the right question. The right question is, what skill set does Adam Aron really have? He is an expert in memification, and what he's doing is bringing his memification from the movie theaters over to gold mining. And if he can successfully do that, well, the sky's the limit. So far, just from this investment a couple days ago, he's already up 16%. And if he could get the swaths of retail investors on board with the meme potential that could follow, who knows how high this thing can fly. So there's your meme update for the week. Now moving on, we have big news from Starbucks that their CEO is stepping down and they're bringing in Howard Schultz for the third time, who was the one that started the company. He was the founder of it, and he's coming back to try to fix some of the issues that Starbucks is facing. The first thing that I'd point out is I think it's interesting that Howard Schultz is not being paid for this. They say that they're going to pay Mr. Schultz $1 in base salary and allow him to participate in the company's employee benefit plan. He won't receive other compensation or benefits. So he's not really getting paid anything except for like their health insurance. Now, I think that's kind of cool, but we also have to keep in mind that he has a net worth of somewhere around $4 billion. So I think the reason he's stepping back into Starbucks is because he likes the company, he has a long history in it, and he wants to help it without even receiving direct compensation. Now, there's two major things that they're addressing right now. They're trying to make sure that their operations in China go smoothly and that they avoid incident, and Starbucks is also facing a unionization effort. Now, they say that Starbucks has faced the most serious unionization drive in its history in the past year, as some workers have agitated for better pay and conditions. And Mr. Schultz, the now CEO, the founder of the company, is actually traveling to the locations and addressing them before they have their unionization vote. He explains the founding of the company and their modern day operations. So who knows how this is going to turn out? It seems like this is picking up a lot of momentum, especially right now as workers, employees have a lot of the power. They say that Starbucks said last year it would boost barista pay, a wage increase now underway, along with 2 previously announced increases. They were slated to constitute an additional $1 billion in spending on employees. So this could dampen the margin slightly as they're increasing pay for their employees. So when I look at companies like Starbucks, it's tough to factor in this type of news, these type of qualitative, unique events that don't really show immediately in the fundamentals, but they're developments that you need to keep track of. I look at a company that has very solid fundamentals. They have pricing power. They have very strong EBITDA growth. They generate well over $1 billion of free cash flow per quarter, and they seem to grow their dividend very consistently. So overall, I consider Starbucks to be a very strong fundamental company. And I think that the management team will come up with new ways to deal with these new challenges. For example, one way we know that Starbucks is lowering their operating expense is by transitioning more and more locations to take out or pick up only. Starbucks said that it would close some of their traditional cafes and open more to-go locations as a chain known for spreading coffee shops across the globe bets more on convenience and speed. So Starbucks has actually closed hundreds of locations and reopened them as these takeout and delivery locations, which have a lot less overhead and better unit economics. So in my opinion right now, I think that these employee issues might be challenges in the short term. They have to make their employees happy and feel like they have a good job working at Starbucks, so they'll have to have some give and take there. So overall, I do view this as a challenge and a potential risk for the company, but it doesn't deter me from holding it. Now, in the last piece of news, we have mortgage rates going up 4% since the first time in 2019. Now, I don't want to discuss the housing market too much. What I want to discuss are these type of headlines. You're going to see a lot more of them over the next year because the federal funds rate went up 0.25% today, and it's going to continue to go up throughout the rest of this year. The basic summary is that when interest rates go up, the cost of money is higher. That's called the cost of capital. The price to borrow money becomes more expensive for everyone, for individuals and businesses. And when you look at this and try to factor it in with your portfolio, I think there's two important things to factor in. The first is keeping track if any company you own relies on debt. By relying on debt, I mean the company takes out debt to fund growth. And without the debt, they can no longer fund the growth. That's not a great company for this current situation. I have many companies that have some level of debt. Apple has some debt and Microsoft has some debt, but neither of them are reliant on the debt to fund growth. In fact, they have far more cash than they have debt. The company in my portfolio with the most debt is Disney. Disney has $14 billion in cash, $47 billion in debt, which is a net debt position of $32 billion. So Disney's reliant on debt right now. And as the cost of capital goes up, this debt may become more expensive for Disney. The next question you have to ask yourself is, do they have pricing power? Can the company offset the cost of capital by increasing prices? Well, when I look at Disney, I think this is a company that has enormous amounts of pricing power. They can raise the prices of their parks, they can raise the prices of their plush toys, they can raise the prices of their streaming service. They have pricing power across the board. So even with interest rate rising, making it a little bit more expensive for Disney, they have all the tools to be able to offset that expense. So overall, I try to invest in companies that have very little debt. I do that because it means that they have less risk. There's less of a chance of them going bankrupt. But that also has the benefit of them not relying on the debt markets and not having their cost of capital increase, which can hurt their profits. So I think the two most important things you have to ask yourself as the cost of capital is going up is, do my companies rely heavily on debt? And if they do they have pricing power to be able to offset those costs? Because if they rely heavily on debt and they don't have pricing power, they could be in a difficult situation. So that's all for now. I'll have more content out in the future. If you enjoy this type of content, just make sure you're subscribed and I'll catch you in the next one.